Let's say you finally have $1,000 saved up. You put it in a normal bank account thinking it's completely safe. But most standard savings accounts pay almost nothing in interest, maybe 1 penny for every $100. Meanwhile, the cost of everything around you is going up. Think about your favorite lunch. A burrito that cost $8.50 6 years ago might cost $12 today. Because of this slow price creep, which we call inflation, your $1,000 buys fewer and fewer things every year. It's like leaving an ice cube on the counter. Even if nobody touches it, it's slowly melting away. The only way to stop the melting is to put your money somewhere it can grow faster than prices are rising. When you invest, your money earns a little bit of extra money. Then that extra money starts earning its own money. Like a snowball rolling down a hill, it picks up speed and size the longer you leave it alone. Before we start rolling that snowball, we need to build a safety net. If you invest your only $1,000 today and your car breaks down tomorrow, you'll have to pull that money right back out to pay the mechanic. Keep at least 1 month of basic living expenses tucked away in a safe, easily accessible savings account first. We also need to check for leaks. If you have credit card debt charging you 20% interest, trying to make an 8% return on investments is like trying to fill a bucket that has a massive hole in them. Clear any debt that charges more than 15% interest before you start investing. Investing creates a practical shield for your hard-earned money, ensuring it keeps its value even as prices rise. It is a necessary tool for anyone who wants their savings to last, moving the concept of wealth building out of Wall Street boardrooms and into your own hands. A lot of beginners open a generic investing app and just start clicking, but the type of account you choose matters just as much as what you actually buy inside it. For most people getting started, the best option is a special account called a Roth IRA. To understand why, imagine your money in 2 different buckets. In a regular investing account, every time your money makes a profit, the government takes a little piece of those gains in taxes. A Roth IRA is different. It acts like a completely sealed vault. The catch is that you fund this vault with money you've already paid your normal paycheck taxes on. But once your $1,000 is inside, it grows completely tax-free. When you open that vault in retirement, you don't owe the government a single penny on any of the new money it generated over the decades. Because this deal is so favorable to you, the government places a few rules on it. In 2026, you can only put up to $7,500 into a Roth IRA per year. And while you can take your original contributions back out anytime without a penalty, the profits are meant for retirement, so you generally have to wait until you are almost 60 to withdraw those earnings.
Setting one up takes about 10 minutes. You can go to the website of a major, low-cost brokerage firm like Fidelity, Vanguard, or Charles Schwab and click Open a Roth IRA. Simply choosing this specific account is one of the smartest financial decisions you can make. It allows time to do all the heavy lifting for you, knowing that when you finally cross the finish line, you get to keep every dollar inside. Now that you have the account open, you have to choose what goes inside it. Do not take your first $1,000 and buy stock in a single trending tech company or whatever cryptocurrency people are talking about online. Betting on one company is incredibly risky, and if they have a bad year, you have a bad year. Instead, we want to buy a tiny sliver of hundreds of the most successful companies in America all at once. We do this by buying an index fund, like one that tracks the S&P 500, which is simply a single package containing the 500 largest publicly traded companies. Think of an index fund like ordering a massive mixed pizza. Instead of betting your whole lunch on a single pepperoni slice, you get the entire pie. One slice might be technology, another is retail, and another is healthcare. If one sector of the economy burns a little, the rest of the pizza is still perfectly fine. This strategy might sound boring, but it works. Buying everything and holding on to it consistently beats out over 75% of professional money managers who spend all day trying to guess which individual stocks will go up. Even Warren Buffett recommends simple, low-cost index funds for almost everyone. When you buy an index fund covering the whole stock market, you are aiming for the long-term historical average, which has hovered around 8 to 10% per year.
Some years will be much higher, some will be lower, and sometimes the market will temporarily dip. By choosing an index fund, you are betting on the long-term innovation of the entire economy, rather than trying to predict which specific company will invent the next big thing. The best way to handle market dips is to ignore them entirely. Successful investors use That means you invest a set amount of money on a regular schedule, no matter what the stock market is doing that day. You can log into your new brokerage account and set up an automatic transfer from your checking account. Pick an amount you can easily afford and schedule it to move over on the exact same day every month. This takes all the emotion and guesswork out of the process. This chart shows exactly what happens when you build that habit. Start with $1,000, add $100 a month at a 10% return, and you'll have over $200,000 after 30 years. Notice how the chart spikes upward at the end. The biggest gains arrive in those final years. Connecting this math to a specific goal makes the discipline feel effortless. This ground balance funds a future month in Italy without a second thought for the bill, or the quiet confidence of a retirement where every basic need is already covered. People often worry that the market is too high right now, or that they waited too long to begin. The truth is, the single biggest advantage you have is time. The best time to start investing was yesterday. The second best time is today. Your first $1,000 acts as the anchor for a financial system that builds wealth while you sleep. By automating your contributions and leaving them to grow, you are turning a simple sum of money into a machine that works for you for the rest of your life.